Good morning, everybody, and Happy New Year. Welcome to Saxo's Global Market Call. It is Tuesday, the 2nd of January 2008, and we start with a comment on FX from John Hardy.
Thanks, Christopher. Getting off the week or the year, I should say, in pretty interesting fashion here, as we saw the dollar really crumpling to end 2017. Normally, we don't expect huge moves around the holidays. Of course, not entirely sure what is driving this move. We have end-of-year liquidity. The idea there that end-of-year liquidity could be a factor, or are we looking forward to 2018 and people want to be positioned for the year ahead, figuring that this is all about the U.S. fiscal dynamics in the new year. This new tax reform bill that has been passed is going to mean a significant widening of the U.S. budget deficit, a deficit that was already going in the wrong direction to start the year. So I think that could be, and being added to actually by the Fed's continued quantitative tightening, as any reduction in the balance sheet has to be offset with increased net lending by the U.S. government. So it's a interesting picture, and of course we'll know better, I think, the quality of this move into the end of this week. We've got, of course, big U.S. data points coming up, ISMs and the nonfarm payrolls and employment data on Friday. And liquidity returning, so we'll have a better sense at the end of this week the quality and persistence of this move. If we look at something like Aussie dollar, however, there's some pretty clear immediate Aussie drivers as opposed to dollar drivers. We have strong commodity prices. Iron ore has picked back up. There's been a lot of attention on copper, which is at multi-year highs, and we saw a strong China PMI overnight for the Caixin. And this is driving an Aussie recovery. It's been pretty considerable. If we're getting up above, I think the 618 retracement here, we're starting to talk about an outright rejection of the whole move back below 77, 78 in Aussie dollars. So we're keeping an eye on that as well into the end of this week and in the weeks ahead. For Europe, of course, the euro is strong. We're back above 120 in euro dollar. Some modest existential concerns out there. We have the ECB reducing its purchases by half as the calendar rolls over. So we'll be watching for things like Italian bond auctions, as Italy is widely seen as the weakest fiscally right here. And we have elections called for early March in Italy. The concerns are rather modest, but we have seen a 20 basis point widening in, for example, the German to Italy 10-year interest rate spread. So let's look at that as well. And on the existential front, we also have the worries about Catalonia and the Article 7 Poland issue. So keep your eye out for that as well. Today, some minor stuff. The final December manufacturing PMI is from Europe, manufacturing PMI from the UK, as well as from Canada. And this week, it gets a lot busier as we head into the end of the week. We've got FOMC minutes tomorrow. Really not much to look for there, as it's Yellen's final meeting anyway. And we're looking at this flash CPI on Friday for the Eurozone, as well as all the U.S. employment data and the ISM non-manufacturing as well. That's it for me. I will turn you over to Peter on equities.
Thank you, John. We're starting this year with a bang out of China. Equity markets up almost 2%. We're also seeing bids in the fixed income market as well. We have the People Banks of China is cutting their reserve requirements for the financial system. They have the February holiday period there, which typically is a pretty stressful situation for the financial system. Typically, in previous years, they have easing the financial conditions through repos in the market, but this time around they're cutting the reserve requirements temporarily, and the market apparently is excited about that. I think it's I think most of it is noise, but obviously the gains here this morning is driven by financials in China. More broadly, excuse me, on China, MSCI China index was up 52% in 2017. That was on top of a 7% gain in the yuan against the US dollar. We remain overweight China again here in 2018. We think the rebalancing of the Chinese economy will continue to progress rather smoothly, although there will be bumps on the road, but it seems like things are stabilizing, and consumer consumption is very strong in China at this point in time. Also keep in mind that when we get to the mid-year of 2018, we'll have 220 mainland shares being adopted into the MSCI Emerging Markets Index. Will be the first time ever. It's going to be a major event, and it will increase China's influence and exposure in the emerging market space for investors dramatically. And we also had news out over the weekend from Chinese regulators that they will continue to be on the path of opening up markets for foreign investors, both in public markets but also in private markets. If we look at the Eurozone growth, we have the every first day of the month we have the Eurocoin real-time GDP tracker out of Europe. It's now hitting an 11.5 years high here. We are now estimating having 3.7% annualized growth. This is the chart. So you can see here the rebound in Europe's economy, continues. I would not be surprised if that at one point will begin to fill into strong European earnings for corporates that we'll see here in Q4, which will be released in February, at least for Europe, and also in March, of course. The big joker this year, I think it could be the Italian election, which will be at latest by May this year. That could be a negative event. Let's see how that plays out, but that's definitely something to watch. And then we will continue with our view that we put out before Christmas, or we started already in mid-December with that we think that the PMI figures and other soft data surveys that are more forward-looking will begin to disappoint against expectation when we get later into this first quarter, maybe in the end of February. And if we get that disappointment, we could see a stock market correction. Nothing major here. Maybe 7% would be in the normal correction. And just look at the MSCI World Country Index. I mean, we have seen a straight line last year. It's the first time since 1988 that we had positive gains in every single calendar month. It really smelled a lot like the dot-com period. And if we look at valuations, we are at the highest end of the valuation bands in more than 15 years. But having said that, on a relative basis, against the fixed income, equities do still remain the most attractive asset class. And for Q4 earnings season is going to be very key for momentum here, so that's something to look for. And then tomorrow we will be diving into the more short-term views again on equities. I just wanted to really take a more helicopter view today and paint what to expect for this year. And with that, I will give the word back to Christopher. Thank you.
Thank you very much, Peter. It's interesting. So 2017 was a very, very strong year for equities, and it will be interesting to see how it will go for 18. According to Bloomberg, strategists are still bullish on 18, and the median forecast for Eurostoxx 50 is 3,750, which indicate about a 7% gain. But we will, of course, follow this with interest on our morning meetings going forward. So with that being said, I wish you all a nice day, and we will return tomorrow at 8:40 CET.